Welcome back, and looking to our business news now. Lease rates in Dubai have risen by an average of 17% over the past 12 months, according to the latest report. The latest market update from property consultant CB Richard Ellis shows that the market has seen rising activity levels in downtown Dubai, Dubai Marina, the Greens, Jumeirah Beach Residence and the Palm Jumeirah, with lease rates increasing by an average of 24% year on year. Experts say that this higher rental growth is off the back of a sustained period of population growth, positive economic performance, increased occupier demand and limited availability of quality units in the most desirable locations.
Particularly for residential, it's interesting to note that with only 36,000 units coming through over the next 3 years, this is actually a depleted development pipeline to what we've seen back in, say, 2007 and 2008, where you were averaging annual supply of around 40 to 50,000 units per year. So what we're seeing now is very much a reduced development pipeline, and I think that is reflected really in the rental growth that we've seen this year. So we wouldn't be surprised actually on the back of this whether you see more developers looking to get back into the market to try and fill this gap for good quality assets within premium locations.
Matthew Green, the head of research and consultancy at CB Richard Ellis Middle East, went on to talk about the appreciation of sales over the past 12 months, off the back of a boost in investor confidence.
About 14,000 residential transactions over the course of 2012, certainly from year to date, and 80% of those were cash transactions. We have seen some improvement in the sales market over the course of the year. This has been a little more muted than the leasing side of the market. I think we're around 12-13% growth over the past 12 months. The commercial office sector was another component of this report as well. And what we've seen over the course of the year is a slight dip within rates within the CBD, but generally I think conditions have been pretty stable, and we see a continuation of that trend into 2013 as well.
GCC retail sales have been forecast to hit nearly 1 trillion dirhams by the end of 2016, according to a report. According to a local paper, Alpen Capital revealed that retail sales are to grow at a compound annual growth rate of 7.7% between 2011 and 2016 to reach 992 billion dirhams. Experts say this is due to increased spending power, a growing population and an expansion in tourism and hospitality. Food retail sales are to grow at a rate of 8.8% for the period, while non-food retail sales are likely to grow at an annual average growth rate of 6.6%. Additionally, duty-free and travel retail sales in the Middle East are forecast to grow 11.6%. And with that, let's now take a look at the stock indices across the GCC. And looking to other news, Friday's US non-farm payrolls surprised on the upside and showed that 146,000 new jobs were created during November, despite the impact of Hurricane Sandy earlier in the month. Well, we earlier spoke with Gaurav Kashyap, the head of the DGCX desk at Al Pari Middle East, for his view on the figures and its impact on the trading week ahead.
Well, we approached Friday's report with a lot of caution. If you look at the figures, sure, there were about 146,000 new jobs added, but this followed severe downward revisions to September and October's reports. Also, if you look at the overall participation rate, the number of people actively seeking work in the US, that dropped to its lowest level in 30 years at 63.6%. What this means is 542,000 people actually left the labor force as a result of either retirement or, more importantly, being discouraged from work. So when you have the unemployment rate dropping down to 7.7%, a lot of that has to do because of the shrinking labor force, and as a result, those numbers are slightly skewed. A closer look at the numbers show that key component sections such as industry, manufacturing, and construction actually lost jobs, and only jobs were added in the leisure as well as healthcare sectors. So overall, we're very, very guarded with regards to this report. Of course, we did see a strong rally on Friday on this misguided optimism, but entering into Monday's trading session, already we're seeing the risk-off trade as a result of developments from Italy and the global growth story, which showed that Chinese exports have slightly slowed down, and that's going to be a key driver of sentiment to kickstart the week. Looking at the rest of the trading week, of course, we have the FOMC rate decision on Wednesday. Of course, they're not going to be looking at any interest rate changes there, but overall, we're expecting to see an increase in the QE purchases from the Federal Reserve. They're probably going to look at increasing their asset purchases up to 85 billion per month. This up from 40 billion as the Operation Twist program comes to an end at the end of this year.